There is a paradox at the heart of the global economy. Collectively, the nations of the world owe $315 trillion. But if every nation is in deficit, who exactly are they indebted to? The answer is counterintuitive. The world effectively owes this money to itself. However, while the liability is collective, the collection of interest is specific. This massive accumulation of red ink isn't a sign of economic failure. It is the system functioning exactly as it was designed. The $38 trillion in US debt isn't a problem to be solved. It is the structural requirement for the currency to exist at all. That means when politicians promise to pay down the debt, they're promising something the system itself cannot survive. To understand this, we must examine the fundamental architecture of modern finance. We traditionally view debt as a temporary burden, a financial hole that must eventually be filled. But in the current monetary framework, sovereign debt functions very differently. It is not a hole. It is a foundation. For every liability on a government's balance sheet, there is a corresponding asset on a bank's balance sheet. This is the critical inversion. One entity's debt is another entity's safe collateral. Consider the role of the United States Treasury bond. In the financial world, this isn't merely a bill that needs to be paid. It functions as pristine collateral, the most liquid, reliable asset in the global economy. Banks, pension funds, and insurance companies hold trillions in government debt, not just because they want to lend to the state, but because they are legally and structurally required to hold safe assets to balance their risk. The entire repo market, the deep plumbing of the global financial system, where trillions of dollars are exchanged overnight, runs on this government debt. Banks use these bonds as security to borrow cash from one another. Without a massive, ever-growing pool of government debt, this lending market would seize up. This relationship creates a dependency that few people realize exists. The banking system creates a structural dependency not through force, but through liquidity requirements. If the supply of government bonds were to shrink, we would face what economists call a safe asset shortage. Paradoxically, in this inverted world, a government running a surplus is a threat to financial stability. A debt-free government means a collateral-free banking system. This is why the debt ceiling is always raised. It is not a political choice. It is a systemic imperative. This leads to a stark conclusion regarding the solution to debt. If the United States actually paid off its debt, if it sent a check to every bondholder and retired those bonds, it would effectively destroy the banking sector's balance sheet. The safe assets underpinning the derivatives market and interbank lending would vanish. The system effectively prohibits solvency. Consequently, the flow of interest payments becomes a permanent feature of the economy. This dynamic creates a structural transfer of wealth. The government must tax the productive capacity of the citizenry to service the interest on the debt, funneling that liquidity to the bond-holding class. It acts as a reverse annuity, where the public pays a perpetual fee for the privilege of using a currency backed by their own future labor. The debt is not meant to be repaid, it is meant to be serviced. To understand how this engine of perpetual obligation was constructed, we need to look past modern politics and examine the moment it was engineered in 1694. To understand why this structure exists, we must examine the moment it was engineered in 1694. At that time, England was locked in a war with France that it could not afford. King William III had exhausted the treasury, and traditional lenders were refusing to extend credit. In the past, monarchs borrowed personally. If they died or simply refused to pay, the lender was ruined. Sovereign lending was a high-risk gamble. The king needed money, but he had no collateral left to pledge. Enter William Paterson, a Scottish merchant, with a proposal that would fundamentally alter the relationship between state and finance. He suggested a loan of £1.2 million, a massive sum for the era. But the terms were revolutionary. Unlike previous royal loans, this principal was not intended to be repaid. Instead, the government would only be required to pay interest at a rate of 8% annually in perpetuity. This shifted the paradigm of public finance from debt repayment to debt service. Paterson's group of lenders did not want their £1.2 million back. They wanted the guaranteed tax-backed income stream that the interest payments provided. To secure this, The king granted them a royal charter to form the governor and company of the Bank of England. The government pledged specific duties on shipping and alcohol to ensure the interest payments, effectively earmarking future tax revenue to service the bondholders. This arrangement transformed the national debt into a permanent annuity. For the government, it provided immediate liquidity without the political cost of immediate taxation or the deflationary pressure of draining gold from the economy. For the bankers, it created a risk-free asset. As long as the British state existed and retained the power to tax, the interest would flow. The debt became a fixed feature of the state's architecture rather than an emergency measure to be eliminated. It was no longer a sign of royal insolvency, but the foundation of private solvency. However, the most critical component of Paterson's blueprint was the concession regarding currency. The Bank of England was granted the right to issue banknotes up to the value of the government debt it held. When the government borrowed, the bank accepted the debt as an asset and printed paper notes against it. These notes then circulated as money. This created a closed loop. The government issued bonds, the bank bought them, and the bank issued currency backed by those bonds. This mechanism established the rule that money is born from debt. Before this, money was largely gold or silver, commodities with intrinsic value. After 1694, the dominant form of money became a credit instrument, a claim on the government's future taxation. The more the government borrowed, the more notes the bank could issue. Conversely, if the government had paid off the debt, the backing for the currency would have vanished. This created a symbiotic relationship where the state's hunger for cash matched the bank's hunger for interest-bearing assets. The genius of this design was that it incentivized the state to remain permanently in debt. A debt-free state would mean a bank with no assets and a currency with no backing. This model proved so effective at financing wars and industrial expansion that it was rapidly replicated across Europe. By the time the American colonies declared independence, this system of central banking and permanent public debt was already the standard. It was this specific blueprint, the monetization of perpetual debt, that would eventually cross the Atlantic and form the basis of the modern American financial system. By the early 20th century, the American economy had become the largest in the world, yet its financial infrastructure remained perilously fragile. The United States still relied on a decentralized banking system where the supply of money was tethered to the physical availability of gold and the reserves of individual banks. This rigidity culminated in the Panic of 1907, a liquidity crisis so severe that the New York Stock Exchange nearly closed. The system was only saved when financier J.P. Morgan personally organized a coalition of bankers to inject liquidity into failing trusts. It became clear to the financial elite that the modern economy required a mechanism to expand the money supply on demand, a lender of last resort that could monetize debt instantly. The solution was drafted in secret in 1910 during a meeting at the Jekyll Island Club off the coast of Georgia. There, Senator Nelson Aldrich and executives from the nation's most powerful banking houses sketched the blueprint for what would become the Federal Reserve System. While presented to the public as a means to stabilize the currency and prevent panics, the structure established by the 1913 Federal Reserve Act served a more fundamental purpose. It industrialized the relationship between government debt and money creation. We need to look closely at the mechanism of open market operations because this is the engine of the modern economy. In this system, when the federal government spends more than it collects in taxes, the Treasury issues bonds, promises to pay in the future. In a purely free market, these bonds would have to be bought by private investors using existing money. If investors lost confidence in the government's ability to pay, they would stop buying, interest rates would rise, and the government would be forced to balance its books. Market discipline would constrain state spending. The Federal Reserve removes this constraint. Through open market operations, the central bank purchases these government bonds from the private market. To pay for them, the Fed does not transfer existing funds. It simply creates new reserves in the banking system. It credits the seller's account with a digital entry. This is the moment of alchemy. The government's debt is transformed into new base money. The bond sits on the Fed's balance sheet as an asset, and the new currency flows into the economy. This creates an unlimited demand function for government debt. Because the central bank has the theoretical capacity to purchase very large amounts of debt under extraordinary conditions, there is effectively no ceiling on how much the government can borrow, provided the central bank is willing to facilitate the transaction. The bond market no longer functions solely as a judge of fiscal responsibility. It becomes a transmission belt for currency creation. The structure of the Federal Reserve was carefully designed to obscure this direct link. It acts as a hybrid entity, a network of 12 regional banks owned by private member banks, overseen by a board of governors appointed by the president. This independence creates a necessary distance between the politicians who spend the money and the technocrats who print it. If the Treasury simply printed money directly, the inflationary consequences would be obvious to the electorate. By routing the process through a central bank that buys bonds on the open market, the system maintains the illusion of arm's-length borrowing. However, the functional outcome is identical. The government issues debt, and the central banking system ensures that debt is monetized. This architecture allowed the United States to finance 2 world wars and the expansion of the modern welfare state without immediate taxation. It turned the national debt from a simple liability into the raw material for the money supply itself. But while this system solved the problem of liquidity, it introduced a fatal mathematical flaw, a trap hidden in the calculation of interest that ensures the debt can never actually be extinguished. The most critical aspect of this system is not hidden in a secret vault. It is preserved in the public record of the United States Congress. The confirmation that our money is nothing more than a debt instrument came on September 30th, 1941, during a hearing of the House Committee on Banking and Currency. The witness was Mariner Eccles, the chairman of the Federal Reserve at the time. He was facing questioning from Representative Wright Patman, who was probing the fundamental nature of how the Federal Reserve created funds to buy government bonds. The exchange that followed strips away the complexity of modern economics to reveal the stark reality of the ledger. Patman asked Eccles where the Federal Reserve got the money to purchase $2 billion worth of government bonds. Eccles replied, "We created it." When pressed on what backed this money, Eccles delivered the definitive statement on the modern financial structure. That is what our money system is. If there were no debts in our money system, there wouldn't be any money. This admission confirms the trap inherent in the design. Money in this system is not a commodity like gold. It is a credit entry on a balance sheet. It exists only because someone, a government, a corporation, or an individual borrowed it into existence. But while this explains the origin of money, it does not explain the mathematical impossibility of ever settling the accounts. That problem lies in the calculation of interest. Consider the mechanics of a single loan. When a commercial bank or a central bank extends credit, it creates the principal amount of the loan. If you borrow $1 million, the bank types that number into your account. That money is created out of thin air. However, the bank requires you to pay back the principal plus interest. If the interest is 5%, you owe $1,050,000. The system creates the principal, but the interest must come from additional borrowing elsewhere in the system. This creates a systemic interest gap. The total debt obligation, principal plus interest, is always mathematically larger than the total money supply, principal only. The only way for the borrower to pay that interest is to acquire money that was created by someone else's loan. We are effectively playing a game of musical chairs where the number of chairs, the money supply, is always deliberately smaller than the number of players, the debtors. To prevent mass default, the system requires a constant injection of new debt. New loans must be originated to create the money required to service the interest on old loans. This establishes a mathematical imperative for exponential growth. The money supply must expand forever, not because the economy is growing, but because the debt burden requires a larger pool of currency to service it. If the lending stops, the liquidity to pay the interest evaporates, and the wave of defaults begins. This leads us to the concept of money destruction, which is the inverse of money creation. We are conditioned to view paying off debt as a moral and financial virtue. But in a debt-based monetary system, paying off a loan is an act of deflation. When a borrower repays the principal to the bank, that money does not go into a vault to be lent out again. The liability is settled, the asset is removed, and the digital entry is extinguished. The money ceases to exist. This brings us back to Eccles's warning. If the United States government were to pay off its $38 trillion debt, and if the private sector cleared its balance sheets, the result would not be financial freedom. It would be a total evaporation of the money supply. There would be no currency left to facilitate trade. This is the scenario that unfolded between 1929 and 1933, when a cascade of loan repayments and defaults shrank the money supply by a third, causing the Great Depression. The system is therefore designed with a fail-safe. We cannot pay off the debt because the debt is the money. The economy must simply outgrow the burden or inflate it away. Repayment is mathematically impossible without collapsing the currency itself. This domestic trap creates a permanent treadmill for the nation, but in the post-war era, this mechanism was expanded into a global instrument of control. This domestic mathematical trap was eventually expanded into a global instrument of control. The mechanism for this expansion was the post-1971 fiat era, where the US dollar became the sole reserve currency of the world, unmoored from gold. Throughout the 1970s, American commercial banks flooded developing nations with cheap loans, recycling petrodollars into infrastructure projects in Latin America and the Global South. These loans were often variable rate, a structural detail that would soon prove catastrophic for the borrowers but highly profitable for the lenders. The trap snapped shut in 1979 with the Volcker shock. To combat runaway domestic inflation, Federal Reserve Chairman Paul Volcker raised interest rates to unprecedented levels, effectively restricting the global supply of dollars. The federal funds rate peaked near 20%. While this stabilized the currency at home, it devastated nations abroad that held dollar-denominated debt. Almost overnight, the cost of servicing their loans tripled, while the global recession crushed the value of the commodities they sold to pay those debts. In August 1982, Mexico announced it could no longer service its $80 billion external debt. This was the moment the system faced a binary choice: allow default and let the banks take the loss, or engineer a new mechanism of debt continuity. They chose the latter. A default by Mexico would have triggered a chain reaction, bankrupting the major New York money center banks, Citi, Chase, and Bank of America, that were leveraged to the hilt on sovereign loans. The banking sector's solvency was entirely dependent on the fiction that these debts were performing assets. The solution was the transformation of the International Monetary Fund from a balance of payments stabilizer into a global debt manager. The bailouts provided to Mexico, Brazil, and later Argentina were not designed to forgive debt or help the populations of those nations. They were designed to protect the balance sheets of the creditors. The IMF provided just enough liquidity for these nations to continue making interest payments to Wall Street, effectively laundering public money into private bank earnings. This was the birth of extend and pretend, rolling over unpayable debts to avoid recognizing losses. In exchange, these nations were forced to accept structural adjustment programs. This was the geopolitical equivalent of the domestic interest trap. To qualify for new loans to pay old interest, governments had to dismantle their economic sovereignty. They were forced to privatize state assets, cut public spending on healthcare and education, and reorient their entire economies toward exports to earn the hard currency needed to service the debt. It turned sovereign nations into permanent indentured servants, transferring their productivity to creditors in the global north indefinitely. During the 1980s, this mechanism resulted in a reverse transfer of wealth. For the first time, more capital flowed from the developing world to the developed world in debt service than flowed in as aid or investment. The debt was never meant to be extinguished. It was restructured to ensure the interest payments never stopped. This established the modern paradigm, a global web of interconnected obligations where default is prohibited not for moral reasons, but because it threatens the collateral chain. We live in a world where nations remain in permanent service of their debt, terrified that if they stop borrowing, the liquidity required to run their economies will vanish. This brings us to the final realization about the $38 trillion figure. The inability to pay off the national debt is not a sign of political incompetence, nor is it a bug in the software. It is the operating system itself. The global financial architecture, from the 1694 Bank of England to the modern Federal Reserve, requires perpetual borrowing to maintain liquidity. If the debt stops growing, the money supply contracts and the system collapses. Understanding this mechanism shifts your focus entirely. You stop waiting for politicians to fix the debt and start preparing for the inflation that the system mathematically necessitates. The only way to reconcile the math is to make the currency worth less, so the nominal debt becomes manageable. The debt will not be paid, it will be debased. The system is working exactly as designed. If you found this analysis valuable, hit the like button and subscribe to the Financial Epoch for more deep dives into the history of our economic system.